cutting back, sacrificing, saying no to things you wanted, watching that number in your account slowly climb, and then, in the space of about 3 weeks, watching most of it disappear. Not because of bad luck, not because the economy collapsed, but because of a mistake, a completely avoidable mistake that nobody warned you about. That's not a hypothetical story. It happens to real people every single day. First-time investors who were doing everything right, saving, trying to build a future, who got tripped up by something they simply didn't know. Most of these mistakes aren't complicated or obscure. They're just things nobody told you. Until now. Today, I'm going to walk you through the most costly mistakes beginners make sure you never have to learn these lessons the hard way. Let's start with the one that gets the most people, because this mistake doesn't feel like a mistake. It feels like wisdom. It feels like patience. It's called waiting for the perfect moment to invest, and it is one of the most expensive habits a beginner can develop. Here's how it plays out. You have money saved, you're ready to invest, but the news looks scary. The market is at an all-time high. An analyst on TV predicts a crash, so you wait. A month passes, the market goes up a little more. Now it feels even riskier, so you wait longer. 6 months, a year, and the whole time your money is sitting in a savings account, earning almost nothing. A study by Charles Schwab looked at 5 different investors over a 20-year period. Each had $10,000 to invest every year. The investor with absolute perfect timing, investing on the single best day each year, did very well. But here's the crucial part. The investor who just invested on the very first day of each year, no timing, no waiting, ended up with only about $15,000 less than the perfect timer, over 20 years. And the investor who waited in cash for the right moment, they finished last by a lot. The conclusion is undeniable. Time in the market beats timing the market every single time. Stop waiting for perfect. Perfect never comes. Okay, this one might sting a little because almost every beginner makes it. You start investing, maybe you learn about index funds, and then you hear about a stock. A friend mentions it.
You see it trending online. The story is irresistible. This company will change everything. And your brain lights up. What if this is the one? So you put real money in. Sometimes it goes up for a while, which only makes it worse. You get confident. You put in more. And then it drops hard and fast. Here's the data. A landmark study by Professors Brad Barber and Terrence O'Dean analyzed 66,000 households over 7 years. Their finding was brutal. The more actively people traded, chasing individual stocks, reacting to news, the worse their returns were. The most active traders underperformed the market by an average of 6.5% per year, every year. That gap, compounded, does staggering damage to your wealth. It happens because our brains are wired to find patterns, to believe we can outsmart the market. But the market isn't a puzzle with a solution. The answer isn't to be smarter, it's to stop trying to be clever and start being consistent. This next one doesn't happen when things are going well. It happens at the worst possible moment, when your portfolio is down 20, 30, 40%, and every instinct screams, get out before it gets worse. It's called panic selling, and it is the single most reliable way to turn a temporary loss into a permanent one. Here's what really happens during a market crash. The market drops fast. Inexperienced investors sell. They tell themselves they'll get back in when things stabilize, but the market doesn't send you a notification when it's about to recover. The biggest recovery days, when the market jumps 5, 10% in a single session, almost always happen in the middle of the chaos, when the news is still terrible. If you miss just the 10 best days in the market over 30 years, your returns get cut in half. Those 10 days almost always happen right after a crash. By the time things feel safe again, the recovery has already happened. A Dalbar research study found something sobering. Over a 20-year period, the S&P 500 returned about 9.8% per year. The average investor in those same funds, they earned about 6.8% per year. That 3% gap, lost purely to emotional decisions, costs you over $200,000 on a $100,000 investment. The loss isn't to the market, it's to fear. The antidote is to understand that crashes are normal. They've happened dozens of times, and the market has recovered every single time. They aren't emergencies, they're sales. I need to talk about this one directly because it has cost a generation of young investors an enormous amount of money: cryptocurrency. I'm not saying crypto is worthless or has no future. What I am saying is that for most beginners, the way they approach it isn't investing, it's gambling with the emotional intensity of investing. You know the pattern. A coin explodes. Someone turned $1,000 into $50,000. The excitement is electric. Beginners pour money in, not because they understand the technology, but because they don't want to miss out. Then the coin crashes, 60, 80%, and they're left holding an asset they don't understand, waiting for a recovery that may never come. A study by the National Bureau of Economic Research found that retail crypto investors consistently bought near peaks and sold near bottoms. If you want exposure to crypto, treat it like the speculative, high-risk asset it is. Never put in more than you can afford to lose completely. It should never be the foundation of your financial plan. The foundation is boring. The speculative stuff is the small percentage on top, not the other way around. This next mistake is quiet. It doesn't make headlines, but over a lifetime, it might cost you more than any single bad decision ever could. Investment fees. Most people see a fund charging 1% per year and think, that's nothing. Here's why you should care, deeply. Let's say you invest $100,000 and it grows at 8% per year for 30 years. With no fees, you end up with about $1 million. With a 1% annual fee, you end up with $760,000. That tiny 1% fee cost you $240,000. A 2020 study by Morningstar confirmed it. The single best predictor of a fund's future performance is its expense ratio. The lower the fees, the better the long-term returns, because every dollar paid in fees is a dollar that isn't compounding for you. When choosing a fund, look at the expense ratio first. A broad market index fund should cost you less than 0.2% per year. If you're paying more, you need a very good reason. Diversification. It's a word everyone hears, but most beginners get it wrong in one of two ways. Failure mode 1, no diversification. This is the person who puts everything into one stock or one sector. They're confident, but when you concentrate your entire portfolio in one thing, you take on enormous risk for no additional expected return. A single index fund holding 500 companies is fundamentally safer than picking 5 companies you believe in. Failure mode 2, over-diversification. This is buying 10 different funds that all hold the same stocks. You think you're diversified, but you're just paying multiple fees for the same exposure. True diversification means owning different types of assets that behave differently. For most people, 1 or 2 broad, low-cost index funds covering the global market is all you need. Simple, effective, proven. Complexity in investing almost always benefits the person selling the product, not the person buying it. Here's a mistake that's become dramatically worse in the age of social media: trusting financial predictions. People who sound authoritative, who have large followings, who speak with total confidence about where the market is going. A study by psychologist Philip Tetlock tracked the predictions of nearly 300 experts over 20 years. His conclusion? Their predictions were barely more accurate than random chance, barely better than flipping a coin. And yet, we make real financial decisions based on their confident proclamations. The incentive of financial media isn't to make you wealthy, it's to keep you watching. The market might go up or down is accurate, but it doesn't get clicks. This stock is about to explode does. Ignore short-term market predictions from everyone. Focus on what you can control: your savings rate, your fees, and your own behavior. Okay, we've talked about what not to do. Let me end with what to do, clearly and simply. 1. Start immediately, now, with whatever you have. 2. Buy broad, low-cost index funds. Keep the expense ratio below 0.2%. 3. Automate your contributions. Set a fixed amount to invest on the same day every month. 4. Never sell during a crash. When the market drops, and it will, do nothing or invest more. 5. Ignore financial predictions and hot stock tips from everyone. 6. Check your portfolio as infrequently as possible. Quarterly is plenty. 7. Increase your investment amount every time your income increases. That's it. 7 rules. The strategy that builds wealth isn't exciting. It doesn't make for viral content, but it works. The fact that you're here learning this already puts you ahead of most people. The difference between the investor who builds real wealth and the one who doesn't is rarely intelligence or income. It's awareness, knowing what the mistakes are before you make them, knowing that the boring, simple path is the one that actually leads somewhere. You now have that awareness. The mistakes we covered today, these are the things that quietly destroy the financial futures of people who are genuinely trying. Now you know them. Now you can avoid them. And that knowledge, compounded over a lifetime of better decisions, is worth more than any single investment you'll ever make. I have a question for you. Have you made any of these mistakes? Which one hit closest to home? Think about it, because honesty is where change starts.